panel on wholesale CBDCs and cross-border payments. I'm John Orchard, OMFIF's CEO. In OMFIF's regular discussions at its Digital Monetary Institute, we've heard the conversation at and among central banks move a little away from retail CBDC for now, certainly at the West central banks. From what I heard earlier, there's perhaps a greater keenness in some countries in this region. I also heard some familiar challenges. Certainly, retail CBDC looks superficially simple to those who are used to digital payments on their phones, but is more and more complicated the closer you look for a whole host of social and systemic and practical reasons. And meanwhile, the US regulators have slowed down an insurgency from a stable coin with the potential to upend the financial system, meaning perhaps key central banks can relax a little. What we have seen, though, is an increased focus on the wholesale payments infrastructure, where central banks may indeed offer access to new private sector entrants, perhaps. And we've seen attention shift to cross-border payments. Without those, there's little point, I have to say, in major national initiatives. And that's a stumbling block in these discussions many times. Cross-border payments are, of course, already working in the existing architecture, but plenty of people regard it as expensive and inefficient and ripe for disruption, as indeed we heard on the opening panel. Albeit the dreaded issue of interoperability, which arises in all CBDC discussions, has already been solved in the existing architecture. Nevertheless, incorporating DLT and technologies like it could enormously improve the speed, efficiency and liquidity of both transaction services and also capital markets. There are plenty who say that wholesale CBDC already exists in the form of balances transmitted across RTGS and systems like it. And it's just waiting for better technology and potentially to be integrated with a wider variety of counterparties beyond commercial banks and a few others. So we'll explore all of that and plenty more with a panel that has a useful cross-section between public and private sectors, existing infrastructure and new technologies. So we're very pleased to have with us James O'Brien, Head of Regulatory Development at Central Bank of the UAE, Sara Castellano, Managing Director, EMEA, Head of Payments and Solutions at JP Morgan, Phantom, CEO of the Sovereign Wallet Network, and Koji Fusa, CEO of GVE. James, kicking straight off with you, we've heard commentators on the Federal Reserve in our own network describe CBDC as a solution looking for a problem. Do you think that's true in this region? What's the current state of wholesale payments infrastructure in the region, both interbank and cross-border? And what do you think needs fixing? Over to you, James, and then we'll hear from the others.
Yeah, thanks for that, John. I think that's a good place to start because normally you start a process where you have a problem, and you know, in my own opinion, do we have a problem? That is the question. Perhaps we don't have a problem in terms of a functioning system, but the challenge, and maybe that's where the problem lies, is how do you future-proof a system, and is the existing system, I think, capable of being future-proofed, or do we need to have something else? So I think if you look at this region, you know, the plumbing works, you know, the infrastructure works, that there is cross-border activity, the settlement happens. Could it be improved? Absolutely. And I think we heard in some of the earlier conversations that there's a lot of work going on in that area. And certainly, you know, the improvements are tangible, you know, efficiency, speed, et cetera, et cetera. I think the challenge is to replicate what we've got in terms of the oversight of the financial market infrastructure, and to make sure that we don't throw the baby out with the bathwater. So there's a lot of innovation. Innovation brings its own challenges, and I think that's where the focus needs to be. But I think to answer your question directly, is there a problem? No, in the sense that the plumbing works. Is there a problem in that we need to future-proof or think about where the financial system is going? And I think that's what the efforts, certainly in the UAE, and in this region are focusing on, that there is a distinct change in customer requirements, consumer sentiment. There's a distinct change in what people expect. There's a distinct change in the technologies available. That's changing, I would say, almost week to week. So it's an opportunity, and I think that opportunity needs to be taken now, because there is change already here. There is change coming, and I would suspect that what we see today will not be what we see here in 5 years' time.
So from your point of view, it's about opening up potential rather than solving something that desperately needs to be fixed, notwithstanding various gripes about cost and efficiency.
Yeah, I think we can always improve, and I think that there's always, the issue of time, and there's also always the issue of efficiencies and cost savings. I'm a bit skeptical about cost savings, because I always think that the cost savings element of any sort of concept never really considers the extra cost of the new technology, if you like, or the new risks that are probably inherent in any sort of innovation. So I think we are where we are as we might say, in the sense that we have a system. It works. Does it work as efficiently as possible? No. Is it broken? Probably not. But can it be improved? Absolutely, yes. And I think that's where the focus is at this point.
Okay, thanks. Just a quick supplementary question to you before we move on to the others. James, in the retail space, we've heard many times about worries of disrupting the financial architecture. So, for example, if you accidentally defund banks, you tamper with the magic of fractional reserve banking. If the retail population decided not to bother to have deposits, there are different views on that, but it is a risk. In the wholesale space, there seem to be less, to me anyway, systemic risks of that sort. Is that true and fair? What's your take on that?
Yeah, I mean, I guess the wholesale is a good place to start. So at least then you're going with sort of, I would say, economies of scale and strength in less, I would say, less activity, if you like. So I think that probably is true in the sense that it's more manageable. Nevertheless, the risks are the same, because if the wholesale financial infrastructure stops working, you certainly have big problems, as much as you have problems in the lower end of the scale.
Okay, thanks, James. Sarah, over to you and welcome. Thank you very much for joining us. We've heard that there isn't a desperate problem, but there are opportunities. How would you compare the Gulf, the Middle East, to other parts of the world in terms of payment systems, status, and what could be improved and what is already being done better than elsewhere? Over to you, Sarah.
Thanks. I agree with James that we have payment systems running, and they've been running for a very long time, and we're moving money around the region and globally on a day-to-day basis. And there is obviously always room for development, and you have underlying consumers that are changing what they want, which has essentially a knock-on impact what banks and central banks need to be able to provide. What our underlying consumer is driving, and that's why it becomes quite complex, because from a consumer wanting everything on demand to banks moving money in interbank windows and settlement, I think that's been something that we've been dealing with as an industry. What we have seen is the launch of instant payments, like Saudi going live with real-time payments. I think that's a great movement into supporting an underlying consumer move cash instantly. And we've seen instant payment methods essentially pop up all over the world, because what it does is it starts isolating that retail traffic, which needs to move instantly, and it's often in small amounts, and the wholesale traffic, which is larger amounts that essentially require additional liquidity and more steps in that process. And I think the region has done that really well by splitting the two. I think globally, the move to using enriched data with ISO 20022 XML is really the foundation for helping us as an industry kind of deal with some of the noise that we hear that banks are slow and they can't move money. And that's often because banks put a lot of checks on transactions. Because if we are moving money, we want to know who's in the parties, regardless of it bank to bank or retail. We really need to understand the cash movement. Now, with the current architecture and using SwiftFin, often you don't have enough information on a transaction, so you have to stop it and review it. That's always been the case from a sanctions screening and money laundering perspective, but we've seen an increase of fraud in the ecosystem, whether it's underlying consumers getting phished and having fraud or corporates getting phished and having fraud. So you're in a world where we want to move money quicker, but we're actually stopping it more because we want to add more checks to it. So enabling enriched data gives the information so you could potentially put a passport number into a transaction, or you can add additional technology into your infrastructure, whether you're a commercial bank or anyone in that banking chain, and saying, look, I want to use machine learning or artificial intelligence so I can identify fraud patterns. And with ISO, the data is structured, and structured data is easier for machines to read. And I think the region is doing a really great job with a plan on all the financial market infrastructures moving to ISO. And I think the world is coming to a point now where ISO is a reality, and financial market infrastructures around the world are adopting that. I think if we get enriched data to move with transactions, we leverage some new technologies like machine learning and artificial intelligence, I do think we'll be able to move money quicker in both the interbank space, and we have obviously the retail space. So I think that's really a good way for us to move. But that's supporting us today. And we really need to start thinking about, and I think why groups like this are great is because we have the immediate ask, which is move money. We're all doing that. We all do it really well. Get ourselves to continuously improve and then set us up for the future. And whatever we are investing in, we need to make sure it's future-proofed and it's more secure and it's stable. And it's really, if you're going to invest in technology, you want to invest in technology for the next decade, 2 decades, rather than making any short-term decisions where you'll just have to reinvest again.
Okay, thank you, Sarah. The AML KYC point comes up a lot in these discussions, and initially that was somewhat forgotten that commercial banks provide that as part of the infrastructure, and some of the DLT solution providers don't have good answers for that. Others do, including those here. So we'll move on to that in just a moment. I mean, certainly anecdotally, I was asked to transfer money to one of my children at the weekend, and I said, don't bother, it won't happen today. And she looked completely baffled. So I think you're right that there will be a generational pressure on that one, is absolutely right. Koji, over to you. You have experience of the commercial banking sector, of course, as well as now working for a technology solutions provider. Following on from Sarah, what actually is wrong? As James has pointed out, money can move around okay. Actually, the current system solves lots of headaches that still haven't been solved in some of the CBDC discussions. What's wrong, and where do you see the benefit of a major change with digital CBDC or similar technical proposals? Koji.
So, John, as you pointed out, the CBDC is very ill-defined concept. So some people include offline, which is completely contradictory to digitalization. So I think if you define properly a CBDC, then that is going to enhance the financial stability. Because remember that in the credit crisis, everybody wanted to have a narrow banking, and narrow banking is possible if you have an online 24 hours, 365 days. Because then things are going to in real time. So even the Lehman is going to go collapse. You can predict what kind of effect is going to be done in real time overnight. And then you can pump exactly the amount of money you need to save the financial system. So I think that CBDC is going to save the situation next time of the situation like credit crisis. The problem is this offline concept, or sometimes in the cross-border payment. in some of other panel says, it takes still the T+2 for cross-border payment. That's not real time, right? So, and then if everything can be done, let's say within a second, then of course things is going to be different, and this financial stability is going to be improved. So if you don't think about now, but think about 2030, what is a vision? And the region, regional wise, Middle Eastern is good because, as Sarah pointed out, Saudis, UAEs, and Bahrain, all those people who are participating in today's discussion, they are very futuristic compared with G7 countries. As you pointed out, Fed, Bank of Japan, other central banks of the G7 countries, they are very, very conservative. They want to reserve the cash. They think that cash has to be there even 2030, but not futuristic countries in the Middle East.
But one of the reasons they do that, Koji, I mean, we're back on retail just for a moment, is they know that their populations are very wary of all the data and privacy issues that would be implied by CBDC or an account-based CBDC with the central bank. There are cultural obstacles to that we found in some developed markets. Just Koji, on your narrowbank point. That's also a worry, isn't it? I mean, if the system became entirely narrow banks, we would massively shrink the global economy. Is that, you're not suggesting that, I don't think.
No, I'm not suggesting. And just going back to the privacy issue can be solved by another ISO. ISO 20022 is good, but there's another online 24 hours, 365 days online ISO, which was published last year, called ISO 24643. If you look at that one, that is going to give the platform which can protect the privacy. So this payment service provider doesn't see who is actually transacting. It is only the bank who has gone to KYC, knows that account belong to whom. So for example, if I have a account in the JP Morgan, the JP Morgan see my transaction, just like now. But those transactions which are not, they have done the KYC, they should not look at. And that's a sort of both wholesale and the retail CBDC. So that's a privacy issue. So privacy issue can be solved. Just people are thinking that it is going to be the central bank which is giving the account to everybody. That's not what I'm proposing. What I'm proposing.
I want to do that. We'll set, just for now, not spend too much time on that because it's more of a retail headache than a wholesale one, and I know they're linked. But thanks, Koji. To you, Phantom, first your reflection on the state of the payments infrastructure in this region in particular, and then more broadly the opportunity to upgrade it or the obstacles to upgrading it, as we heard from Sarah, Koji, and James.
Okay, sure. So first of all, I think we need a new blockchain-based wholesale and cross-border payment infrastructure to reduce cost and increase interoperability. To make this possible, we need a whole new blockchain design. The fundamental reason why the blockchain-based CBDC project failed is that there is a fundamental design problem of current anonymity-based blockchain, token blockchain. For example, we are still very much struggling to satisfy FATF's travel law. To overcome this, we need to completely redesign the blockchain technology to meet the needs of CBDC requirement. Especially, we need a blockchain technology that solves the CBDC design trilemma. That is three conflicting goals: identity and privacy and programmability should be all satisfied. Many people think that it is not possible to solve these dilemmas. However, there exists a way to solve these dilemmas. For example, identity versus privacy, just we mentioned, that can be achieved by combining decentralized identity blockchain with token blockchain, resulting in identity-based token blockchain. So applying this decentralized identity technology such as self-sovereign identity is an important concern in terms of compatibility and interoperability point of view. We need a standard-based interoperable account address mechanism to send and receive digital currencies between banks and between countries. One more important blockchain technology that is required to implement dynamic currency multiplication in the current fractional reserve banking model is meta blockchain technology. In current blockchain technology, we still need to program smart contract to publish digital tokens, i.e. digital currencies. However, in the fractional reserve banking model, we need to be able to dynamically publish new currencies when the bank is lending the money. To automate this, we need a meta blockchain technology that does not require any smart contract programming and dynamically create and destroy the currency in real time based on M1 or M2 currency as a collateralized asset or reserve asset.
Phantom, thank you. Perhaps we'll explore the technology in slightly more detail in a moment. But in terms of the benefits of doing, first the question is, what is the benefit of doing this? Very simply, and secondly, is this technology you would apply to the existing infrastructure, or would it be a new platform?
So basically, it's a private sector and the technology company, I prefer the new platform. So there are a lot of opportunity and the possibility that if you can adapt this DLT and the new digital currency-based payment network, that it can greatly increase the cost. And one of the major reasons that I prefer this new infrastructure is that there are so many unbanked and then unreachable regions. And then the cost and then transfer time is, it takes so much time and cost to do it. So I prefer new blockchain technology. And the problem with many of the new blockchain technology and pilot project failed is because of the approach and then understanding of fundamental structure of DLT and then blockchain technology.
Okay, thanks, Phantom. I'm just going to bring in my other panelists on specifically on blockchain, as it does have its skeptics, and then we'll come back to you. James, and I'm not asking for a technical exposition here either, because you've got a regulatory hat. But what do you think about, from that perspective, from your regulatory perspective, about a revolution versus an evolution on the existing architecture? Do you think that we should slightly improve legacy systems incrementally, or should there be a fundamental overhaul of the architecture with completely new interbank and inter-party platforms? Do you have a high-level view on that idea, James?
Yeah, when I think about this sort of dilemma, I'm sort of minded to all of the discussions I have with various innovative technology firms with great ideas, and I'm always convinced that the technology works, and I don't have any doubt about that. I just think, look, technology does work. Here in the UAE, we've gone to Mars. Excuse me, so there's no reason why the technology doesn't work. But I'm always surprised at the idea that you can replace what we've got as an ecosystem, a regulatory ecosystem, which has been built up maybe over 30 to 40 years in terms of getting to where we are today. And previous panelists have mentioned AML. There's the whole governance aspects to it. It's all of the risk management, all of those type of things that have been well thought out and I guess developed in many cases because of crisis or scars from previous events. And I think what really needs to happen is that whether it's built on the legacy or it's a complete new playbook, it's really about how can we replicate what we have, which has been built up in very good, I guess, structure. There's oversight, there's consumer protection, there's data integrity, There's protections in terms of governance and operational risk management and all those things. How can we build that into, I guess, the vision that Phantom has, which is really, creating something brand new? And I'm sitting a little bit on the fence on the question, John, to be honest with you, because obviously if it could be done with legacy systems, then there's a certain cost benefit to that, and there's also a track record. So it's the legacy is there, it's tested, and all of that. But then with my sort of visionary hat on, I think, well, wouldn't it be really good to create something new that replicates what we've got, but in a whole digitized fashion, right? Almost like straight through from end to end, and it absolutely replicates what we've got. Sarah talked about machine learning and AI and all of those things, and all of those things have to be part of the discussion, because again, you can't have digitalization without digital signatures, without digital KYC. You can't have oversight without AI. You can't create a black box and not have oversight of what's in the black box. You have central banks, are inherently conservative. They want to know where the money flows are. They want to have oversight, and all of those things. And then in all of that mix, you have the huge consumer expectation. You mentioned your daughter, who wants instant payment and can't understand why it takes a week, for things to go through. And yet, if you break it down, why does it take a week? It takes a week because there's a lot of checks and balances built into that system. So the challenge is, how do we build all those checks and balance into that digital system? And if that can be done with legacy system, I suspect probably not. But if it could, I think, from a cost perspective, it would be good. But if we're to really be futuristic and to really future-proof, perhaps we need to build on a new technology with new digital controls.
James, the real revolutionaries of the blockchain crowd seem to me to be talking completely at odds with regulators and others, because decentralized finance is decentralized. Money is hugely centralized because we need oversight of who's paying whom for all sorts of reasons, as Sarah pointed out. Yeah. Phantom and Koji both are suggesting they have answers to that problem, but do you think that can be fundamentally reconciled, those completely different characteristics between DLT and what typically a central bank or other supervisors might want?
Yeah, I think it can to some extent, but I think you can never get away from that oversight requirement of a central bank, purely from a monetary policy, financial stability perspective. So they will want to see where the flows go and where the flows come from. And then you have the whole AML issue, and then and the operational sort of data integrity issues, and all of those things, privacy protections, because the expectation of the customer is that they're fully protected. And it's interesting that the thought processes among consumers is that they want everything much faster, with less control or less friction, at the point of contact, but they want more and more protection, and that's a challenge. And I think that's where the big focus needs to be. I think everything can be solved. It needs collaboration. It needs understanding. It needs full, commitment on all sides. And I think probably central bankers are more at the table than they've ever been in these types of discussions. Usually it's tablets of stone coming down from on high, and the drawbridge drawn up again. Now there's real discussion around these things. There's real discussion around innovation. There's real discussion around consumer needs, financial inclusion, all of those things. So I think I would be very hopeful that those issues can be solved.
Good. Okay. There's a couple of questions coming in, including on the difficult theme of interoperability, and we'll come back to that in just a moment. But Sarah, the banks have done a brilliant job in the past of co-opting revolutions when they have to. I think about peer-to-peer payment platforms 10 years ago, which people thought would upend the way banks work, but didn't really. They for the large part, co-opted them. You've already talked about improvements to the existing architecture. What do you expect to happen? I know that banks are concerned about being displaced by things like Apple Pay, Google Pay, stable coins, and all the rest of it. But also the central banks somewhat have your back for various reasons we've covered. What do you expect to happen in terms of the iteration of the current systems from a commercial bank point of view?
So regardless of what happens, I think commercial banks play a key role in the whole entire ecosystem, because commercial banks offer more than just moving money. They offer wider services around financial products, whether it's to corporates, financial institutions, or underlying retail consumers. So I think they do play a critical role. And I think sometimes we look at it too, you're going to be disintermediarized because you're no longer going to move the transaction. I think people lend the banks are big at lending, and banks also have all different types of support when it comes to payment methods. So I do think commercial banks will still play a really important role in the ecosystem. I do think, though, that today's model for cross-border payments that the banks have created with correspondent banking essentially has a serial movement of money. So you find the bank that either has access to a central bank or a bank that offers indirect access, and you then send money across the chain. I do think new technologies such as blockchain do have that ability to updating ledgers rather than in sequential movements to really in atomic simultaneous updates. So you essentially have that ability to not have to have every single bank in the chain, and you can simultaneously update things. I think that not only removes the need for serial payments, but it also gets you real time and visibility. Now, there's a lot that still needs to be done with thinking about how does liquidity work in that situation, how does the whole entire end-to-end settlement finality work, et cetera. But I do think that the facilitation of essentially wider services is important, and the commercial banks need to play a role. But ultimately, the architecture and the way we move money today, I just don't think that that's going to be fit for the longer term. I also have seen a trend, especially most banks support corporates at the end of the chain, and corporates support individuals, or you do traditional individual banking, the rise of wallet providers. So money leaving the banking and the central banking ecosystem, where I now have a wallet where I can buy coffee. And if I top up my wallet with coffee, I can use it to get free coffees. And it's almost like acting as a closed loop circle that I have with a coffee chain. Now, if you end up with all these pockets of cash and all these different wallet providers, then that becomes very difficult for individuals to manage their cash. But corporates like to do that because it drives brand loyalty, and there's a whole entire ecosystem now popping up of wallet providers. So I do think that there needs to be a way, and I know that there's a lot of discussions going on around how do we support the wider money movement ecosystem, but still have financial institutions and commercial banks essentially play a key role in that, because we add wider value. To your point earlier, we do a lot of the sanction screening and money laundering in the ecosystem, and that's still very core to making sure that regardless of what pocket of cash is available, that we know that it is there for the right reasons, and it's not being used for other purposes. So
might you expect, Sarah, and this will be perhaps a troubling idea for transaction services part of a commercial bank, would you expect corporate treasuries to transact directly with one another at some point with these new payment platforms that we're talking about?
Potentially, they could move money banks do this today. You have settlement across bank books. Being a large dollar provider, we're able to move settlement across our books and across our clients today without essentially going into the central bank system. But I don't see corporate treasurers wanting many bank accounts. If anything, they're looking to reduce it. So if you have to create all different networks and join different networks to essentially talk to other corporates, I think that's really going against what corporate treasurers are trying to do right now. They're trying to reduce their pockets of liquidity around the world, reduce their bank accounts, increase their visibility and control of cash, and also offer innovative solutions to their underlying customers to make sure that they're increasing brand loyalty and driving innovation. Going to them saying you need to open 5 new central bank accounts or 5 new accounts on a distributed ledger, I just don't think that matches what they're trying to achieve.
Okay. Koji and Phantom, I want to give you briefly a chance to address the earlier point about whether a DLT or similar technologies are fundamentally at odds with the requirement of central banks and others to collect, including commercial banks, to collect information about transactions. Over to you, Koji, on that first.
Right. So, first of all, the economic theory says that central bank when they issue money, that's a liability of the central bank. And also the same apply for private bank sector. So if they are going to do the fractional reserve banking system, that's basically that the private bank sector is issuing digital currency. It's the same anonymous to private sector banks is issuing new coins, for example, JP Morgan, right? So DLT is contradicting that economic theory itself. So DLT, there is nobody who is issuer. It's ledgers and the majority is going to vote for, and therefore that there is nobody who is going to be the liability issuer. So that's the difficulty that DLT people is going to face in the long run for the central banks to adopt, or private sector bank is going to adopt. That's one.
So I think you're saying they can't. This can't.
They can't. Yeah. Exactly.
All
so
right.
I think that what Phantom has been explaining is probably maybe a part of a solution, but not entire problem.
Okay.
Yeah. Okay.
Thank you, Phantom. I want to give you. I want to go on to some cross-border issues, some excellent cross-border issue questions I've seen coming. But Phantom, I want to offer you the chance to rebut this and say that you can square this circle of DeFi and centralized information.
Yeah. Also, I'd like to briefly mention about what James talked about. I mean, what I'm talking about is I don't want to completely change the current practice and the infrastructure of the reserve banking model, fractional reserve banking model, and just exactly convert those banking model and the regulatory framework and into the digital currency system. And as Koji-san mentioned that this traditional DLT originally generate from cryptocurrency. Actually, there are long story, but to make it short, I mean, I totally agree that cryptocurrency-based current blockchain technology will never work. I mean, there are a lot of misunderstanding about this blockchain system. It's not decentralized. It's not P2P. It's very centralized operation. I mean, the node structure itself is decentralized, but actually the operation point of view is very centralized. You can process a transaction one by one in a serial fashion. So we cannot really make it faster. And then many believe that CBDC system is only the central bank issuing the money, and what about the commercial bank? And that's not true. But I mean, I agree with the traditional blockchain system is the same, but with the new blockchain technology, if we completely redesign the blockchain technology that can process the transaction in real time in parallel, and then if you can achieve more than faster transaction. And one major benefit of having this new DLT-based system and then new payment network is that we can use the internet. That is most widely penetrate network in human history. And we're talking about, unbanked and then, financial inclusion and everything. But if you can utilize this internet to send the money over this and implement the cross-border payment, we don't really have to completely replace this new CBDC system with a current system. We can augment that.
Thank you, Fenton. And we've drifted a little bit back to retail, but thank you. We may have broken the hearts of a series of private equity companies funding technology companies by saying that DLT won't work for these reasons, although who knows, it's an innovative sphere. So I've got some questions coming in from other central banks, actually. I think it's well worth putting them. So back on stablecoins, Facebook, Diep. So this is from Abbas al-Basha, former vice governor of the Central Bank of Yemen. Despite their recent glitch, he says, how far could Facebook's DM constitute disruption to wholesale CBDC prospects in terms of cross-border transactions? We've got several other questions on cross-border. James, I'm going to turn that over to you first, which I know you may slump in your seat at this annoying question, but the US regulators sat on it quite hard, I think, but stable coins could be quite disruptive. What do you think?
Well, yeah, I mean, look, it's an opportunity, or it's an out in many respects, whereby we're looking at, and maybe it's more importantly, it's probably a defensive strategy, if you like, in the sense of creating a stable coin. At least it's not Bitcoin, or it's not a coin that's going to fluctuate greatly in price. So it's linked to something. It's linked to either fiat, or it's linked to a basket of currencies or whatever. So to some extent, central bankers are, of the view that this is more appealable, if you like, in the sense that it can be recognized as a form of currency, if you like. And when we look at those other types of assets that do fluctuate quite considerably, it's very difficult to look at those as a currency. Really, it's an asset of speculation, if you like. So I think the jury is out on stable coins to some extent. I think there is thinking that they are stable, and then there's another body of thinking that says they're not stable, and there's potential there to be just as volatile as the other asset. I think at this point the jury is out. I think we're constantly looking for something that we can pin our comfort on, and stablecoin at this point is something that we feel we can pin our comfort on, particularly if it's backed by fiat at least, and it's got some type of intrinsic backing, if you like, from a stable perspective.
Mike, just a quick adjunct before I move on to a different version, or rather a similar question from a different central bank. But James, on that, isn't the answer potentially that you would regulate a stable coin as if it were a bank, and then plug it into a wholesale CBDC, but leave them to deal with the public, heavily regulated, including with reserves?
Yeah, I mean, these are options, obviously, and I'm in my own personal opinion, the central bank should stay out of sort of the commercial aspects of it. So, as much as we can provide the sort of the stability and the infrastructure and the enabling aspects of it, then in reality, you want the functioning commercial industry to be generating the economy growth, if you like. So yeah, I think all of those things and all of those options should be on the table.
Oh, good, interesting. Sarah, a slightly modified version of that question we've had from Majed Al-Adwani, the Central Bank of Kuwait. And Majed says, what would be the potential impact of CBDCs on international remittances sent abroad through money transfer operators? Would there be a disintermediation of current market participants? You're not really one of those, but perhaps you perform a similar service. What do you think about that? In other words, to James's point just now, might central banks accidentally compete with the private sector by introducing a CBDC?
So it really depends on what segment you're going after. We've had a lot of conversations in the CBDC space around the retail consumer, and remittance is essentially an individual on the street trying to send money somewhere. So I think if going into retail is something that kind of gets worked out, then absolutely I could see that as a competition. But I don't think that the focus at this point has been really at the retail consumer. It's really about how do you think about the current architecture and increase it, and that's predominantly that bank-to-bank settlement model. I do think in that space, remittance could be taken over by the likes of a Facebook if everyone just moves money across that. Right. But then it's how do you get the money out of the system to actually pay your bills, or you use essentially what your Facebook money is used for? Can you get it out? And then that goes back to, does it come back into the banking system? How does the central bank deal with it? And I think it's sometimes great to see these wallets. And like I was saying, you can have wallets in all different cases, but once you need to abstract the money from the system, it still has to come through a clearing and settlement rail outside of that wallet. Okay.
Koji, while we're on international cross-border payments and interoperability, which quickly leads us to wicked problems when we talk about it in other sessions. But we've had a question in from Kasim Kamari, Progress Soft. For interoperability between CBDCs globally, does the panel believe you need to create a backbone network for cross-border payments to span across the CBDCs? This is a very difficult issue because who would govern that? But what do you think, Koji?
The solution with the existing system is, in our opinion, is this. At the moment, the banks, private sector banks, together with everybody, can do the KYC. You need to have a KYC to have a bank account. But once you have it, let's say 8 billion people, all of them, including children and babies, have it. And from that point, that it is a matter of how to manage real-time gross settlement. So at the moment, each country has a real-time settlement or clearing house with, let's say, 2,000 financial institutions. But if you have a very good server, which can process much faster, much more money, then you can cover 8 billion. And some parts, the ledger or database is going to be covered by central bank, just like now. And some parts is going to be covered by private bank, sector bank like JP Morgan. So nothing's going to change in terms of supervision. What's the difficult part for what the government has to decide is, in the past, the Walmart has to apply for banking license to make a stable coin. Now, by calling it stable coin, it's just like Facebook is issuing their points, right? So they are not really thinking that this is the currency, but in fact, back of the people's mind, consumers' mind, for Facebook people, DM is going to be Facebook is promising that can be converted into one of the stable currencies. So it's actually the same thing, but the definition of stable coin versus points is not clear anywhere. So you need to clarify. And then US government or people can say that you need to have a banking license, therefore that you have to have a bank. And Federal Reserve Board or somebody can say, no, we are going to deny your application, just like what they did for Walmart, right? So US government has done this before. And so they have to have a thinking process and making each of the definition much clearer. And you don't really have to change how to govern the financial system.
Okay, thank you, Koji. James, I want to come to you on this. I'll come to you in a moment, Phantom, with your idea for the international architecture of CBDC. But James, this becomes quickly a difficult conversation, the interoperability, cross-border interoperability one, albeit there has been a pilot, hasn't there, that your central bank has undertaken with SAMA. Tell us a little bit about that first, and then go on to what you think about the broader question of, does a new backbone need to be created for all CBDCs between central banks to transact with one another?
Yeah, first of all, the project you're speaking about, John, is called Project Aber, and it was a concept piece of work done between ourselves and SAMA, so the UAE Central Bank and SAMA, sometime last year. And effectively, it was to look at distributed ledger technology and see if our commercial banks could settle through those that technology cross border, and the currency was pegged to the dollar. So effectively, it was a digital currency pegged to the dollar. So we were in a lucky situation in the sense that we had a currency that was matched with some. So
no FX headaches, no real-time FX headaches.
Exactly. Yeah. So that was that was successful. It proved that it could be done, but it's still it stopped short, I think, of answering all the questions that we just had the discussion on here around governance and the privacy issues and all of those things. So the technology works. So it goes back to what I said at the very outset. The technology works. No question about it. And if the conditions are right, it works fantastic. So if you've got those synergies across jurisdictions, it's perfect. And then when I look at your second question around this area, that's where the difficulty lies. Yep. I think anyway. It's really about you're going cross border, you're going cross jurisdictional, you're going cross regulatory, you're going cross culture, you're going cross thinking, you're going cross a lot of things, and if you don't get those things right at the outset, you can run into a lot of difficulties. And when I personally think about this, I think about is this interoperability issue very great, and I think it is very great in a multilateral sense. Where you're going beyond a partnership approach. And I think once you take a partnership approach, you've already identified a mate, if you like, and you're quite happy to run with that, and you can get over the issues around regulatory issues through collaboration. Jurisdictional issues, laws can be changed. But I think once you go beyond that, then you have got the issue of that standardization that's required for it to be truly interoperable.
Okay, so, thank you. Koji, I'll come to you in just a minute on this. But James, just a supplementary question to that. An HSBC or a Citigroup or a JP Morgan would tell you they can already move money from one end of the world to the other across currencies. Why do central banks need to find a way to be able to do that with a parallel rail? And there are all sorts of answers to that, but what do you think about that?
Well, I think it's to do with I would say financial stability to some extent. I mean, in the sense that it really is something that needs to be considered in a. And I know we had some of this discussion earlier on, but it really is something that we need to consider very carefully. I think that we want to have the oversight, as I said earlier on. We want to have the oversight from a money flow perspective. We believe that we can produce an enabling environment for that to happen. The commercial banks are doing it, as you quite rightly say, but they are overseen by central banks or regulators. So there is that element of oversight there. So from that perspective, we certainly still want to have that tentacle into the system. And I think, going back to all of the discussion that we've had earlier on, I think if that can be solved and accommodated, I think then we have something that we can move forward on. I think if it can't be accommodated, as Koji has mentioned, then I think a lot of this is going to take a long time to come to fruition. And maybe that's what's happening in the West at this point.
That's very clear. Thanks, James. Koji, you wanted to come in, and then
yes, sorry, yeah, I forgot to answer one of your question. Yeah, so basically the current system, there is already the server and the internet or mobile, using mobile, including latency of mobile in each country, let's say 0.2 second. You can transaction cross-border transaction as long as there's a market for exchange. And this is going to be done within 2 seconds. And that's probably what some of the banks are saying that they can do. And central bank, you don't really have to do it. It's just you can do it to leave it to the private sector.
In other words, you're saying don't bother trying to solve interoperable CBDC across border between central banks.
Okay. Correct. They can do it. They can do it, but they don't have to. because the private sector can do it.
Okay, good. All right. Phantom, what do you think? I think you probably wouldn't necessarily agree with that. What's your view?
No. And it's better for me to simply mention about the ABBA project. And then you can see my point. And I have three comments on the ABBA project. And then ABBA project use settlement coin to enable cross-border payment. So this is an anonymous token-based system. Again, there's the problem of identity versus previous cryptocurrency-based anonymous token-based system. So I mean, it's obviously difficult to satisfy FATF law, and also there's the issue who will be the authority to publish this and maintain this common settlement coin. So I suggest the use of kind of new technology like meta blockchain capability to overcome the need for settlement coin. And we can enable the direct sovereign currency to sovereign currency exchange without using the settlement coin. This kind of thing cannot be possible in the legacy system and never been possible. And then now we can have a direct currency to currency system. And for the interoperability point of view, I would suggest use of, I mentioned about we need a standard-based interoperable account address. So we can have a technology like self-sovereign identity to overcome with this. And self-sovereign identity meaning we have decentralized public infrastructure. So a public entity can come in as a metaverse or as an e-government. They can issue the certificate to prove certain activities. And so this this kind of capability never been possible before. And one option that I would suggest is that we can create regional cross-payment using multinational common currency. So one major difference in compared to euro is that we don't need to give up each own country's sovereign currency. We can publish the common currency based on each participating nation's sovereign currency as a currency basket, similar to the original design of the Facebook Libra. So for example, we can publish Arabic common currency based on currency basket of UAE Dirham, Saudi Riyal, Gulf common currency, etc. And with meta blockchain capability, we can set up the collateralization asset to publish a new one. And also we can dynamically mint and bond circulating volume of this Arabic common currency based on the changes of circulating volume of each backup currency, national currencies. So the beauty of this approach is that each nation doesn't have to abandon its own national currency and come up with a new common currency. Each currency can still have their own sovereign monetary policy to support their economic growth.
Very sorry to interrupt you, Fanta. We're just about to run out of time, and thank you. I want to ask one very simple question to the panel to finish up, just to draw sentiment for our audience. Now, I do apologize to Ripple and the Central Bank of Nigeria for not putting your excellent questions. We didn't quite have time, but I just want to ask one very simple question. It's whether the panelists believe that there will be a widespread network of cross-border CBDC in the wholesale arena within the next 2 years. Sarah?
Not widespread, but there could be commercially run networks.
Okay. Koji?
Well, I think that it depends on where you are. Probably developed country is less so, but Middle Eastern country and also less developed countries more needs, because for less developed countries for financial inclusions.
So there's an opportunity for this region. I think that's interesting. Phantom, yes or no to widespread wholesale CBDC across borders?
Yes. Actually, I'm working on many of the small countries to build a cloud-like platform already.
James, yes or no? What do you think?
I think widespread, no, but there will be some elements there, I would say.
Okay. Thank you very much, everyone. I'm sorry we have run out of time, but that was a very interesting, useful discussion. And do join my colleague, Katie Ann, who is about to explore crypto assets. People often muddle up with cryptocurrencies, but she will explore that in just a moment. So it remains for me to thank this wonderful panel. Thank you very much. And thank you all for listening. If I didn't put your question, my apologies, but thank you all very much, and we'll watch this space closely. Goodbye.
Thank you.
Thank you.
Thank you.
Thanks very much, everyone.
Hi, guys.
Thank you.
John.
Thank you, John. Bye.
Bye.